Good morning. Welcome to Market Monday. Last week, Matt mentioned that July has been the best performing month in the stock market over the past 10 years. Also, as we were talking about last week, there seems to be a recession in recessions as indicated by the number of new stories, with the word recession clearly trending lower. This at the same time as the number of new stories with the words marked bull market is exploding.
And remember this, the AAII, American Association of Individual Investors, number of bears, meaning folks who have a negative outlook on the stock market, fewer and fewer as the market goes higher. And not just that, look at the bottom in mid-October of last year. At the bottom of the market, there were the highest number of bears. This isn't at all to say that these investors are somehow bad. It's just human nature. When markets go up, we get more bullish. When markets go down, it seems like there's always more downside to go, same as it ever was.
Of course, when we say market, in most cases we refer to the S&P 500 stock market, which, as we pointed out a few weeks ago, is not the only stock market, but it is the flagship US stock market, which is why from time to time it helps to ask, what is the S&P 500?
The S&P 500 is a group of about 500 US-based companies that are typically larger in size. But each of the 500 companies doesn't have the same weight. For example, the largest stock in the group is currently Apple at a 7.79% weight, meaning almost 8% of the S&P 500 is in Apple stock.
Which seems like a lot, and it is, but if we look back, Apple's been the number one weighting since 2012. We can see during COVID it was still a high weighting, but much less so in the 8 years prior. And before that, ExxonMobil for 6 years. Never as high as Apple, but still a long run at the number one weighting. Let's not forget, it was in 2007 when the first iPhone came out. Then for 12 or 13 years prior, Microsoft and GE traded jabs for the number one weighting. Then back to Exxon, then wow, about 22 years of utter dominance by IBM, spending most of that time at a weighting equal to or even higher than Apple currently is. For good measure, IBM is currently the 62nd largest holding at just 0.33% weight.
That's a good point. Compared to Apple's 7.79% weight, IBM's 0.33% weight seems rather small. In fact, starting at the top, you can see how quickly the weightings fall. The 37th largest holding has just a 0.5% weight. By the time you get to the 120th largest stock, we're already below 0.2% weighting. The bottom 220 stocks out of the 500, give or take, each have less than a 0.1% weighting, almost negligible. So yes, while there may technically be 500 stocks in the S&P 500, your exposure and performance is realistically driven by the top couple dozen largest holdings.
What Matt's saying is, whereas when we look at the weighting of just the top stock, here's the weighting of the top 5 stocks in the S&P 500, currently here at over 24%. It is seemingly elevated starting with COVID in 2020, but clearly that's not always the case. And before COVID, we didn't see that type of concentration since the 1970s when the IBMs, AT&Ts, and General Electrics reigned supreme.
When we discuss investments, we talk about them in the context of advantages and disadvantages. There is no perfect investment. One advantage of an index like the S&P 500 is that you don't have to pick and choose the winners. Naturally, as other companies surpass IBM, your weighting will be shifted to that new stock. Or when Apple becomes larger than Exxon and stays there for 10 years, you don't have to make that choice. In fact, you don't have to do anything at all. it's done for you without you even noticing. So you're always going to own the largest stocks in the US.
Case in point, Amazon, currently the third largest holding in the S&P 500, has been one of the best performing stocks of all time. It was added to the S&P 500 in 2005, and you didn't have to make that choice. You didn't even have to lift a finger. Since that time, the stock is up, you're seeing that right, a staggering 5,649%. However, that wasn't always such a sure bet. Here's a look at how Amazon was viewed in 1999. Have a great week.
And Wall Street isn't concerned that Amazon has never made a profit, not a dime. In fact, it lost $125 million last year. The company says it's investing for the future. Skeptics say it would have to sell every book being sold in the world today to justify its stock price.
I think my generation grew up with Sears. And Amazon is worth 20% more than Sears is worth in market capitalization.
How do you view that phenomenon that Amazon today is worth more than Sears?
Investors are focused on the future. Amazon has growth potential that Sears doesn't.
A couple of geeks who sketched out some software could destroy Sears Roebuck.
That's the beauty of technology and the microprocessor.